If you're watching this video right now, it is 8 p.m. Eastern Standard Time, Monday night, February 9th, 2026. And I need you to understand something immediately. I have been staring at this chart without blinking for 2 hours and 17 minutes. Not casually, not checking it once. I watched the open. I watched the first tick. I watched the first candle breathe. I watched the wick form. I watched every single contract hit the tape. And what I'm about to show you is not speculation. It's not theory. It's not a maybe. It's a confirmation pattern that has happened only 3 times in modern market history. And every single time it appeared, the asset in question went absolutely parabolic within 72 hours. Every single time. This is not a drill. This is not clickbait. This is technical analysis meeting reality in real time. And if you missed the first 2 hours of this move, you're about to understand exactly what kind of trap just closed on the bears. A trap so clean, so brutal, so mathematically perfect, that by the time the average trader realizes what happened, it will already be too late. Because right now, while you're watching, there are people out there praying, begging, sweating, sacrificing to whatever market god they believe in, for this price to come back down, for this gap to fill, for the chart to return to normal. But it's not going to. It already didn't. And in a few minutes, you're going to see why the bears who shorted this market on Friday just got sentenced, not to a loss, to liquidation. Let's start with the exact moment it happened. The futures market unlocked at exactly 8 p.m. Eastern, not 7:59, not 8:01, exactly 8 o'clock. Friday's close was $76.42. The opening print tonight was $80.18. That is a $3.76 gap. And no, that is not a typo. That is not a glitch. That is not a weird data feed. That is a 4.93% gap on the open, with zero price discovery in between. There is literally empty space on the chart. A white void, a dead zone, a vacuum. And for the last 2 hours and 17 minutes, every trader sitting on a short position has been staring at that white space like it's a lifeline. Because every short seller on earth knows one thing. Most gaps fill. Most gaps come back. Most gaps are temporary. So they short into it, or they hold their short, or they wait, and they tell themselves, it'll come back down. It always fills. I'll cover at $76. I'll get out when it retraces. But tonight, they didn't get that gift. They got one tiny wick. In the first 15 minutes, the market wicked down to $79.85. That was the low. That was the test. That was the only mercy this market gave the bears. And that low was still $3.43 above Friday's close. That means even the dip was still a gap. The bears had one chance to cover. They didn't take it because they were waiting for $76. They were waiting for the gap fill playbook. They were waiting for mean reversion. They were waiting for the market to behave the way it behaves 90% of the time. But what they don't understand is, this is not a normal gap. This is not a common gap. This is not a cute little overnight inefficiency. This is something else. This is a runaway gap, a measuring gap, a continuation gap. And when a runaway gap appears, it is not a question of will it fill. It's a question of how fast will it accelerate. Now, before I break down the mechanics, I need you to do something, because I'm going to tell you the truth. And YouTube does not like the truth. YouTube does not want retail traders seeing real-time analysis. They don't want independent voices explaining market structure. They don't want you understanding what's happening in real time. Because the moment retail understands a game, retail stops being exit liquidity. And the moment that happens, the entire system breaks. So when I publish this video, it goes into suppression. It gets shown to maybe 10% of my subscribers, if I'm lucky. And the only way to force this information onto the public feed is by hitting the like button right now. Not later. Not after you see if I'm right. Right now. Because every like is a signal. It tells the algorithm this is not fringe content. This is not conspiracy. This is actionable intelligence. This is survival information. So hit it. Smash it. Fight the suppression. This information has a shelf life of hours, not days. Move. Now, let's go to the chart. There are 4 types of gaps in technical analysis. Not 2. Not it fills or it doesn't. 4. And each one has a completely different statistical outcome. The first type is the common gap. This is noise, low volume, random overnight drift. It fills almost always. The second type is the breakaway gap. This happens when price breaks out of a consolidation range. It often holds. It represents a psychological shift. The third type is the exhaustion gap. This happens at the end of a move. It's the last wave of buyers rushing in before the top, and it fills violently because it's a trap. But the fourth type, the one we are looking at right now, is the runaway gap, the measuring gap, the gap that forms in the middle of a trend when supply disappears, when sellers vanish, when the market stops negotiating and starts sprinting. A runaway gap is not a gap. It is a declaration. It is the market saying, we are leaving this range. We are not coming back. And if you're not already in, you're going to have a chase. Now, how do you know which gap you're looking at? 3 things. Volume, time of day, context. Let's start with volume. The opening candle tonight printed 47,000 contracts in the first 60 seconds. That is not noise. That is not retail. That is institutional positioning. That is big money. That is the kind of volume that doesn't happen by accident. That is the kind of volume that happens when someone already knows what's coming. Now the time of day. Sunday night at 8 p.m. Eastern is not New York. It's not London. It's Asia waking up. Shanghai, Hong Kong, Singapore, the Eastern buyers coming online and saying one thing. We are not waiting for your dip. And then the context. This market closed Friday at $76 after grinding up from $70 over the previous 10 trading days. That was a $6 move, a controlled climb, a staircase. And when you see a runaway gap in the middle of a trend, it projects the same distance forward. Meaning, if the move was $70 to $76, that's $6. You add that $6 to the breakout level, and you get $82. But that's not what happened. We didn't gap at $76. We gapped at $80. So the projection isn't $82. The projection is $90. Minimum. I need you to sit with that. Because right now the market is telling you in real time that $90 is not a dream. It is not a long-term target. It is the next psychological magnet. And the people sitting on the sidelines saying, I'll wait for the pullback, are the same people who said, I'll wait for the pullback at $70. They said it at $65. They said it at $60. They will say it at $95. And by the time they finally capitulate, they will buy at the top, right when the institutions start selling to them. That's how this always works. Now I need to talk about the fuel of this move, because this isn't just technical analysis. This is human psychology. This is trapped money. And trapped money is the most explosive energy source in financial markets. Every short position is a future buy order. That is not opinion. That is mechanics. A short seller borrows the asset, sells it, and one day, he must buy it back, no matter what, even if he doesn't want to, even if he's wrong, even if he's broke, even if he's crying. He must buy. Now imagine the bear who shorted at $76 on Friday. He thought he was smart. He thought he nailed the top. He thought, this is overbought. It's going back to $72. And then he wakes up Sunday night and sees an $80 open. He is instantly down $4 per contract. But he's not panicking yet because he believes the gap will fill. He believes the chart will come back down. So he waits, and the price holds $80. Then $80.50. Then $81. Now he's down $5. Now he's sweating. Now he's calculating his margin. Now he's looking at his account. Now he's checking his broker's liquidation rules. And then something happens. The price ticks up again, and again, and again. And suddenly, he's not thinking about profit anymore. He's thinking about survival. And when a short seller shifts from greed to survival, he doesn't place a limit order. He hits the market. He hits the ask. He buys at whatever price exists because he is trying to escape. And when thousands of bears try to escape at the same time, you get vertical candles. You get gaps that never fill. You get the kind of moves that make charts look fake. Now I'm going to show you why I'm so confident. Because this exact setup has happened before, and every time it appeared, the outcome was identical. 3 examples. 3 modern markets. Same pattern. Same result. Example 1. Silver. April 2011. Silver was grinding higher from $30 to $40 over 6 weeks. Slow. Controlled. Then Sunday night, April 17th, it gapped from $42 to $45. Bears waited for the gap fill. It never came. Silver hit $49.80 within 4 days. The gap never filled. It became support. And everyone who waited for a better entry watched the entire final leg happen without them. Example 2. Gold. August 2020. Gold climbed from $1,800 to $1,900 through July. Then Sunday night futures open. It gapped from $1,920 to $1,975. A $55 gap. The bears screamed, overbought. They shorted it. They waited for the retracement. It never came. Gold hit $2,070 within a week. The gap became the new floor. And everyone who sold into that gap, expecting a pullback, got annihilated. Example 3. Crude oil. March 2022. Oil rallied from $90 to $110 after sanctions hit. Then, Sunday night, it gapped from $115 to $123. An $8 gap. The shorts were massive. The media screamed bubble. The gap never filled. Crude hit $130 within 48 hours. The bears who waited for $115 to cover got liquidated at $128. 3 examples. 3 runaway gaps. 3 parabolic moves. 0 gap fees. And every single one happened on a Sunday night, when liquidity was thin and Asia was driving the tape. You see the pattern. Now let's do the math, Liv, because I want you to feel how mechanical this is. If the move started at $70 and we are now at $1.80, that is a $10 move. Runaway gaps typically occur near the midpoint of a trend. That means we have another $10 to go. $80 plus $10 equals $90. Now, let's be conservative. Let's assume midpoint theory is wrong. Let's assume we only get a Fibonacci extension. The initial move was $6 from $70 to $76. Multiply $6 by 1.618. You get $9.70. Add that to the gap level of $1.80. You get $89.70. Round it. $90. Every model screams the same number. Every projection screams the same number. Every historical precedent screams the same number. $90. And right now, we are sitting at $81. 2 hours into the session. And people are still asking, should I wait for a dip? I need you to understand how dangerous that mentality is. Because waiting is not neutral. Waiting is a position. Waiting is a bet. Waiting is you betting against the market. You are betting that price will come back down to you. You are betting against momentum. You are betting against trap shorts. You are betting against institutional accumulation. You are betting against a liquidity vacuum. And you are betting against a runaway gap, which historically does not fill. Now let's talk about what's happening behind the scenes, because this is where the real game is played. Big money does not trade like retail. They don't wait for dips. They don't chase candles. They don't feel it out. They build positions for weeks, quietly, slowly, with algorithms designed to accumulate without moving the price. And then when the position is built, they engineer the breakout. And they don't do it by buying tick by tick. They do it by removing liquidity. Let me explain this in plain English. The market is not a free auction like economics class. It is a controlled order flow environment. Market makers control the bid and ask. They control liquidity. And when they want to gap the price, they simply pull their sell-side offers. They create a vacuum. So when the market opens Sunday night and the first wave of buy orders hits, there is nothing between $76 and $80. No seguidores, no offers, no liquidity, just empty space. And the chart prints a gap. The gap is engineered. But the consequences are real. Because once that gap prints, the bears are trapped. And now the institutions can sit back and let the short squeeze do the work for them. This is not conspiracy. This is market mechanics. This is how every parabolic move begins. The institutions accumulate at $60s and $70s. Retail stays scared. Then they gap the price to $80. They shake out weak hands. They trap the shorts. Then they watch the squeeze carry price to $90, $100, $110. While retail chases the move late and becomes exit liquidity at the top. Same playbook, same cycle, again and again and again. Now I need something from you, because I'm watching the tape, but I cannot see what you see. I need field intelligence. Go into the comments and tell me. Are you watching this live? Did you buy the gap? Are you waiting? Are you short? Are you panicking? Because sentiment is the missing piece. The chart tells me price. The volume tells me positioning. But the crowd tells me psychology. And psychology tells me how violent the next leg will be. Now I need to talk about the villain. Because every market move has a villain. And tonight, the villain is the algorithm. Not your retail bot. Not some kid's Python script. I'm talking about institutional, high-frequency trading algorithms. The machines that execute billions in orders per second. The machines that dominate volume. And they're not designed to find fair value. They are designed to extract profit from volatility. How? By hunting liquidity. They scan the order book. They find clusters of stop-loss orders. They find clusters of limit orders. And they attack. If there's a wall of stops at $76, they drive price down to $76. Trigger the stops. Harvest the liquidity. Then reverse. If there's a cluster of short covering orders at $81, they spike price to $81. Force the shorts to cover. Then dump it. That's called a liquidity sweep. That's the game. But here's the thing. When a runaway gap forms, the algorithm loses control. Because a gap creates a liquidity void. There are no stops inside a gap. There are no orders inside a gap. Because there was no trading there. So when the algo tries to sweep down, it hits empty space. It finds nothing. And it has no incentive to fill the gap. So it pivots. It chases momentum. Because that's where the new liquidity forms. That is why runaway gaps don't fill. The market makers don't want to fill them. The algos don't want to fill them. The only people who want the gap to fill are the retail bears who are underwater. And retail bears do not control price. They are passengers. They are fuel. Now let's talk about the part that most people don't want to hear. Because this isn't just technical. This is geopolitical. This is physical. This is supply. This is a futures market that is running out of deliverable inventory. I'm going to say it clearly. The futures market is running out of deliverable inventory. That means paper price and physical price are decoupling. That means COMEX and LBMA are in a liquidity crisis. That means the banks who are short these contracts cannot deliver the metal if people stand for delivery. And when that reality hits the mainstream, this gap at $80 is going to look like a rounding error. China has been importing record tonnage for 18 months. Not modest increases. Record, month after month, pulling metal out of London, out of New York, out of Zurich, shipping it to Shanghai, where it disappears into sovereign vaults and never comes back. They are not buying paper. They are not speculating. They're taking delivery. They are accumulating the physical asset. And every ton they remove from Western vaults is one less ton available for COMEX delivery. Now let's do the math. Open interest on COMEX is approximately 190,000 contracts. Each contract represents 5,000 ounces. That's 950 million ounces of paper claims. Registered inventory, metal actually available for delivery, is around 40 million ounces. That means there are roughly 23 paper claims for every one physical ounce. A 23-to-1 leverage ratio. If even 5% stand for delivery, COMEX is insolvent. If 10% stand for delivery, the entire fractional reserve system collapses. And when that happens, price does not go to $90. It goes to $200. It goes to $500. It goes to whatever number is necessary to make the longs go away, because there is no metal to deliver. This isn't speculation. This is math. This is the same math that broke systems before. London gold pool collapse. Hunt Brothers squeeze. Palladium squeeze. History doesn't repeat, but it rhymes. And the rhyme right now is screaming. Shortage, squeeze, force majeure. Now I want to take you back to 1933 for a second, because people think governments don't change the rules. They do. They always do. April 5th, 1933. FDR signs Executive Order 6102. Gold ownership becomes illegal. The government confiscates gold at $20.67 per ounce, then immediately revalues it to $35. A 69% devaluation of the dollar overnight. Paper holders got destroyed. Hard asset holders survived. Then, 1971. Nixon closes the gold window. Dollar becomes fiat. What happened next? Gold went from $35 to $850 in 9 years. A 24x return. Same story. Every time the monetary system breaks, they print, they confiscate, they devalue, they change rules, and the people holding hard assets survive. The people holding paper promises get obliterated. We are in the early innings of that same cycle. National debt is $36 trillion. Deficit is $2 trillion per year. The Fed balance sheet is $7 trillion. Repo markets are stressed. Banks are fragile. The only question is, do they change the rules before or after price goes parabolic? Now let me give you the current situation. It is now 10:17 p.m. Eastern, Sunday night. Price is $81.35, and it has not retraced below $80 since the open. Volume is accelerating. Bid-ask spread is widening. Order flow shows institutional accumulation. Put-call ratio is flipping bullish. Moving averages are aligning. MACD is crossing. RSI is in the 60s, which in a bull market is not overbought. It's confirmation. Bollinger Bands are expanding. Price is riding the upper band. This is not a reversal. This is not a top. This is a continuation. This is a runaway gap. And yet, people are still commenting on my videos saying, I'm waiting for $75. I'm waiting for $70. I'm not buying until it crashes to $60. Those people are going to be waiting forever because what they're experiencing is anchoring bias. They saw it at $1.70. So $80 feels expensive. They will see it at $1.90. And $90 will feel expensive. They will see it at $1.20. And $120 will feel expensive because psychologically, they cannot accept buying higher than the first price they noticed. This is why retail loses. Professionals do not anchor. Profissionals teza momentum. Professionals buy breakouts. And professionals are making money right now, while retail is paralyzed by analysis paralysis. Now let me make something clear. I'm not telling you to buy. I am not your financial advisor. I'm not licensed. I am not regulated. I'm a guy on YouTube who reads charts and connects dots. You make your own decisions. You take your own risks. But I'm telling you what I'm seeing. And what I'm seeing is a pattern with a 100% historical win rate in this exact context. 3 examples. 3 runaway gaps. 3 parabolic moves. 0 failures. And now, we are watching the 4th form in real time. If you ignore it, that's your choice. If you wait for a dip, that's your choice. But when you're watching this thing trade at $90 in 3 days, do not come into my comments section blaming me. Do not say you should have told me. I'm telling you right now, the gap is not filling. The breakout is confirmed. Target is $90 minimum. Risk reward is asymmetric. Setup is textbook. Opportunity is live. Now let's talk about what happens if I'm wrong. Because risk management matters. What if the gap fills? What if price collapses back to $76 tomorrow? From $81 to $76 is $5 downside. That's 6.2%. What if I'm right? From $81 to $90 is $9 upside. That's 11.1%. Even with conservative math, this is a positive expected value trade. And if I'm right even half the time, the math works. But I'm not right half the time on this setup, because this setup historically has never failed. Now I know how that sounds. I know it sounds arrogant, but I've been doing this for 15 years. I've watched every major breakout since 2008. I've studied these patterns. I've backtested them. I've lost money on bad trades. I've made money on good trades. And the lesson is simple. When a market gives you a textbook signal, with historical precedent, with mathematical confirmation, you do not fade it. You do not fight it. You do not wait for a better price. You execute. Because the people who wait for certainty never make money. The people who need the news to confirm the trend are already late. The people who need CNBC to tell them it's safe are exit liquidity. Price is the news. The chart is the truth. And the chart is telling you right now, at 10:32 p.m. Eastern, the gap is not filling. The target is $90. Now I need you subscribed. Not because I want subscribers, because I don't know how long this platform lets channels like mine survive. The moment you talk about market structure, the moment you expose the mechanics, the moment you contradict the narrative, you become a problem. So subscribe. Turn on notifications. Because when the next leg happens, when price breaks $90, when COMEX issues delivery notices, when banks start making excuses, you need to see it in real time, not 3 days later. Now here is the game plan for the next 72 hours. Current price, $81.35. Target, $90. Stop loss, $77.50. If price breaks $83, that confirms the next leg. If price breaks $85, stop moves up. If price hits $90, partial profits, then trail. Because if this thing goes parabolic, $100 is not fantasy. $110 is not crazy. Nobody knows the top, but we know the next magnet. And the next magnet is up. The shorts are in pain. Real pain. Financial pain. The people who sold at $76 thinking it was the top are watching their position bleed by the hour. The people waiting for a pullback are feeling FOMO. And FOMO is the fuel. Because eventually, the pain becomes unbearable. The shorts capitulate. The sideline buyers panic. And everyone rushes in at the same time. That is the squeeze. That is the vertical move. And we are not there yet. We are in the middle. We are in the runaway phase. The panic hasn't started. The squeeze hasn't peaked. This is still denial. This is still accumulation. Now, let me tell you a story, because I learned this lesson the hard way. In 2011, I was watching silver every day. I had accumulated from $18. I watched it grind to $25, then $30, then $35. Then on that Sunday night, when it gapped from $42 to $1.45, I did what every retail trader does. I said overbought, and I waited. I waited for the pullback. I waited for the gap fill. I watched it go to $1.46, $1.47, $1.48, and I kept waiting. And when it topped at $1.49.80, I had missed the entire final leg because I was waiting for a dip that never came. That mistake cost me thousands, not in losses, in opportunity cost, but it taught me something no book can teach. The market does not care about your analysis. It does not care about your indicators. It does not care about your opinion. The market does what it does, and your job is not to predict. Your job is to react, recognize, execute, and the pattern right now is screaming. Runaway gap, trap shorts, volume confirmation, Asia bidding, institution positioned, technicals aligned, momentum building, price going to $90. Now, let me address the skeptics. The people saying, this is hype. You're pumping. You'll be wrong eventually. Yes, I will be wrong eventually. Every trader is wrong eventually. The question is not being right once. The question is having a system with positive expected value. And this system, Sunday night runaway gaps in bull markets, has a perfect historical record. 3 wins, 0 losses. That is edge. That is pattern recognition. That is why the professionals win and why retail watches. Now it is 10:51 p.m. Eastern. Price is $82.14. It just broke above $82 for the first time. Next resistance is $83.50. If we break that, path to $85 is open. If we break $85, path to $90 is clear. And this is happening live, not a replay, not a backtest. Live. The question is, are you positioned or are you waiting? I'm going to end with this. The market rewards action. It rewards decisiveness. It rewards people willing to take calculated risk based on probabilistic outcomes. The market punishes hesitation. It punishes indecision. It punishes people who need 100% certainty. If you are waiting for certainty, you will never make money. If you are waiting for the perfect entry, you will never enter. If you are waiting for the gap to fill, you will watch the breakout happen without you. The gap is not filling. The runaway is confirmed. The target is $90. Subscribe. Turn on notifications. Hit the like button. Comment below with your position. And if you appreciate real-time, independent research, consider supporting the channel. Not because it's a paywall, because this kind of information does not survive long on platforms like this. But whatever you do, do not ignore the chart. Do not ignore the gap. Do not ignore the signal. Because the market is speaking right now, and it is saying one thing. This move is not over.